In this week's video, we'll review the latest charts, data sets, and studies to help us answer the question, is this market reversal the real deal? We'll be moving quickly, so feel free to use the pause button on your video player. In these videos, we often talk about technical analysis and identifying subtle shifts. There are numerous shifts on your screen. All of them lean risk on in the short run. Example, triple Qs divided by defensive staples XLP. Downtrend starts up here. You can see it's a sharp drop. This, during Friday's session, this is at the close, looks different than anything that we've seen in the rearview mirror going back for the most part. This is just a sample of what we saw during Friday's session. Defensive SP low volatility relative to SPY. Had a bullish breakout recently above this consolidation area here, but now it looks like a failed breakout. Very, very similar situation for silver, SLV relative to SPY. Bullish breakout look, now it's starting to look more like a failed breakout. Tech XLK in a downtrend here, February and March. Downward sloping trend line, we cleared it at the close on Friday, March 18th. SCHB, US Broad Market ETF, closed above the downward sloping trend line and above the 50-day moving average. Ryan Dietrich tweet after the close on Friday, March 18th. For only the fifth time ever, the S&P 500 gained at least 1% for 4 consecutive days. Historically, it implies a target a year later, S&P 500 at 57.11 on average. The median gain, hypothetically, 56.90 in percentage terms. Average gain a year later in the historical case is 28%. The median gain basically the same, 27.5. Worst case scenario in the 4 historical cases, a gain of 23%. It's also important to keep in mind that does not include the 4 consecutive days. This is from the signal date, which would be, hypothetically in this case, March 18th. As always, it doesn't predict anything. It just helps us assess the probability of good things happening relative to the probability of bad things happening. Very, very similar analysis after the third day. Here's the Twitter handle here. Here are the returns over here. If you go through and look at U.S. recessions and remove some of those periods that occurred in close proximity to a recession, you can see we have a lot of green over here. When we look at all of the cases, the median gain looking out 12 months, 20.41%. 86% of the cases were positive. The VIX did close below 30 this week. Average gain in historical cases a year later, roughly 22%. Keep in mind, the number of days over here is highly variable. Is a recessionary case. These returns look very, very attractive over here, removing this period. 10-2 yield curve has not inverted yet as of March 17th's close. The economy has been in an expansion 86% of the time since World War II. Twitter handle here. You can pause your video player here, but economically, the strong housing data that we have in hand, the data in front of us, isn't screaming imminent recession. Here's the source of the information down here. We'll move quickly here. The purpose is to show clients some of the things that we'll be looking for in the days ahead. Top of the screen, S&P 500 index. In this case, we're looking at NASDAQ stocks, the percentage of NASDAQ stocks greater than their 20-day exponential moving average. Here, 50-day simple moving average, 150-day simple, and 200 simple. We've got the same data for the NASDAQ 100, NYSE Composite, and the S&P 500 index. These data sets can help us with rare oversold levels, and they can also help us with moves that have the characteristics of a breadth thrust. Let's look at the 2010 case here. Big decline in the S&P 500. We'll compare the 2010 case to the present day here. You can see after the low, you clear these levels here. As of Thursday's close, we didn't have that yet. NASDAQ stocks greater than their 50-day moving average. After the low, you see significant improvement. So we'll be looking for something like that over here. Very, very similar situation here. Here's the low. Here's a retest of the low. Look at the area that's created during the breath thrust-like period here. And then compare that to what we had as of Thursday's close. That doesn't mean we're dead in the water. This helps us with what to look for after Friday's close and in the coming days and weeks. Very, very similar situation down here. Here's the low, and then we get a lot of area quickly on the chart. Present day chart, we've got the oversold look down here, but we'll have to see how this data evolves. This is as of the close on March 17th. This data is updated after the close in the evening. Very, very similar situation here. Now we're comparing the present day to this significant decline in the S&P 500 in 2011. Have some work to do here. Need to clear this and move higher. Need to move a little bit higher and need to see some movement here. All of these charts are as of the close on Thursday, March 17th. Given the market action on Friday, March 18th, we should see some significant improvement, but we'll just have to see how it plays out. Here's the major low in the S&P 500, 2016. Very similar concepts here. This shows you what needs to happen on the charts going forward. This shows you historically what did happen. If you're a stock market bull, you want the right side to look like this, and this. We've seen some things, and we'll probably see some improvement on Friday evening as well. Same concepts here, but now we're comparing the present day over here, 2022, to the plunge here in Q4 of 2018. All of this teal over here tells us the present day chart has some work to do relative to assessing probabilities relative to the final low in the S&P 500. When you can see here, this is what a breath thrust looks like. This is what we look like as of Thursday's close. Not going to guess what it's going to look like. Like every data point, we trade the chart in front of us. Similar situation. Here you're down near the low. Don't have the thrust look in the present day. Doesn't mean we're not going to get it. This speaks to what to look for walking forward. And notice, this takes several months here. It's the S&P 500 on the top. And these breath stats here are the same breath stats. They're just based on the NYSE composite. One possible concern is we really haven't hit some of the oversold levels that we hit in the past, telling us to keep an open mind about more downside. Very, very similar situation. See, we've never hit these green lines. There's a lot of white space in here on all of these charts, and this time the breadth data is based on the S&P 500 index. Doesn't predict anything, just helps us keep an open mind about a wide range of outcomes over the next few weeks and months. We've seen some improvement, but there's some concerns as well. May need a little bit more fear in this market before it's over. The market will make that call. The improving, but not 100% confident weight of the evidence that we have in hand is no doubt in some way related to what's going to happen with Fed policy and interest rates, as well as the Fed's balance sheet in the weeks and months ahead. We have a lot of data points that have been accruing over the past 4 sessions that speak to increasing probabilities of a low. Notice this is February 2016. February of 2016, we already covered what we're looking for in terms of a possible roadmap. You can pause your video player here. Similar stats, S&P 500 stats. This is the peaking process in 2007, great financial crisis. This is the present day. As we've mentioned numerous times in recent weeks, stagflation really needs multiple components. High inflation, we definitely have that in the present day. But the stag part speaks to a stagnant economy and or stagnant growth. You can add a stagnant labor market as well. You can make the case that inflation's going to be higher walking forward. That's really nothing new. We have long-term breakouts on stock bond charts that say the same thing. The question is, will the higher inflation stifle growth? It's the latest reading that we have on credit spreads. So far, they really would say the answer to that question is no at this point. It may change, but it hasn't changed yet. Similar situation. We still have a strong labor market in the present day. If that changes, we'll learn something. Similar situation. We still have better data relative to employment in the present day when we compare it to the 78 to 1982 window. These are examples showing we have the high inflation, but we don't have a lot of evidence of the stag part of stagflation. Data point on the left side of the screen really doesn't scream stag either. And the purpose of covering this last week was to show that in the present day, financial conditions really don't look stagnant yet relative to these periods back here in the 70s. If we update this chart, the latest reading, not a lot has changed. S&P 500 as of the close on March 18th, that area, the June low that we've been talking about for probably 9 months or so now, tested it several times down here, and for the most part, we've held thus far. 3 forms of improvement here. We broke this downward sloping trend line, broke this downward sloping trend line, and we closed above a downward sloping 50-day moving average. Doesn't tell us anything about what's going to happen next week, except that the odds here of a low being in are higher than they were down here. That's it. Doesn't tell you what's going to happen. And this can be used as a proxy relative to the improvement in the weight of the evidence. So the improving odds are reflected in our allocations. The daily DeMark chart, DeMark charts and indicators are proprietary tools from Market Studies, LLC. If you know DeMark, a 9 paired with a 13 speaks to potential trend exhaustion, a higher probability of a reversal. DeMark counts are helpful. This is a small piece of the weight of the evidence. This is the sequential count that you typically would use when the market is moving sideways. The combo count is designed for a strong downtrend. DeMark has 4 major counts. This is the standard sequential count. You can see here, if this chart, SPY, can move in this direction, you can imagine that the data points in the model will start to improve quickly. And our allocation shifts occur based on the rate of change in the data. So if the data starts to improve quickly out here and good things continue to happen, the remaining cash that we have on hand will be reduced at a faster rate. It's also possible that the market is going to run into increased selling pressure near the 200-day and the downward sloping 50-day. That's to be determined. If you know Dow theory, the transportation average, big move off of this low here becomes more meaningful if the transports can exceed this all-time high here, but they're already in striking distance with this near vertical move this week. 3 charts on your screen, all of them have subtle changes. QQQ relative to staples, growth relative to TLT, and XLK in isolation. Have a lot of W-type formations and clearing of trend lines. This is step 1, a break of a trend line. We need 2 more steps. The data is better here. Is it perfect? Not yet. Late in the session on March 18th, S&P 500 equal weight index noteworthy, recapturing the 200-day moving average in blue. Also noteworthy, it never broke down from this area of consolidation, or at least it has not done so yet. S&P 500 60-minute at the close made a higher high above this level here on the 60-minute chart and cleared the downward sloping trend line on the 60-minute chart that goes all the way back to this peak here in early January. Also have a W-type formation and a breakout from the W formation. All it tells us is increasing odds that the market will move a little bit further in this direction. You can pause your video player here. These areas in orange acted as resistance in the past. This trend line, and this trend channel in green. Cleared all of them this week, including the trend channel late in the session on March 18th. This is as of the close. Like everything else, it's a subtle shift. This looks better than anything that we've seen in the rearview mirror going back to this point. at least intraday on Friday, the downward sloping 50-day. If the shorts were really eager to reestablish shorts, we might have seen something like this at the 50-day, where we went up and tagged it and then the selling pressure caused a reversal. Same thing if institutions want to sell into this rally at the downward sloping 50. That doesn't mean they're not going to sell next week, but this is pretty impressive here. This is strong buying power here, and we closed above the 50. So thus far, there wasn't a lot of selling and shorting conviction in this area. Now we still have the 200-day above. It's not shown on this chart. This is the NASDAQ 100 60-minute. This is a common theme. This is the 200-period moving average on a 60-minute chart. Numerous charts for all of 2022, for the most part, have been below that 200-period moving average on the 60-minute chart. Once again, this is a subtle difference going all the way back to early January. ARK Innovation ETF. S&P 500 bottoms in 2016. ARK is here. S&P 500 bottoms at the COVID low. ARK is here. S&P 500 in the present day attempting to rally. ARK near the same potential trend line. So far, we've seen a bounce. Very similar situation here. S&P 500 2009 down here. S&P 500 at the COVID low. S&P 500 in the present day. This is FDN Internet Stocks. If you want to take a pessimistic view of this holding, this is not particularly a good look here with the 200-day moving average. Could show numerous charts like this. During the session on Friday at 11:08 a.m., you can see potential resistance appears to be acting as resistance. There were numerous charts like this. Almost every single one of them cleared whatever level or potential area of resistance was there. That doesn't mean anything, but all things being equal, in terms of bullish probabilities, you'd rather be on this side of this trend line relative to this side. Tech versus the S&P 500 may mean something, may not. Resistance, support in the same general area trying to bounce. This is still clearly a downtrend in the intermediate term and still an uptrend from a long-term perspective. This is an all-time high up here, and we haven't made a lower low yet. XLE relative to XLK weekly, resistance, possible resistance, also the 200-week moving average, possible resistance. The more friendly look here, this is a daily chart, resistance. This is a bullish breakout. If it holds, that would imply that this nice trend here, the nice uptrend in favor of XLE, would continue. Possible inflection point here, looking at these two ETFs on a relative basis. For now, this speaks to interest rate expectations. XLF relative to SPY still has not cleared this level here from 2021, but it's still in an intermediate term uptrend relative to the market, may just be consolidating. Here's an example of one of those defensive breakouts that now looks like a failed defensive breakout. You really say the same thing here. Value breaking out relative to the S&P, and now it's back in the long-term period of consolidation that started way back in May of 2020. XLP relative to VTV ratio crosses the 200-day moving average. The S&P 500 tanks. Crosses it in the other direction here. Stocks do well. Cross it here. So this cross here would be similar to this COVID cross. That kicked off this period of malaise that we're experiencing now. Now we're back below it. We can make an argument that this is more similar to this period here where stocks did well. XME relative to SPY, here's a trend channel. If it can clear it, that would be a massive breakout. The NASDAQ made a new low for the current decline on Monday of this week and then rallied sharply for 4 days. Hence, the reason for adding the bullet point in recent weeks and months of max nimbleness. Something we talked about last week. It makes it difficult to go to 100% cash if you can avoid it. This is during the session on Friday. This is a better look relative to the Bollinger Bands. You can see sometimes when you get a close outside of the Bollinger Bands, you get a bounce back. We had a close outside of the bands trying to bounce back. This is the look of the NASDAQ Composite, Thursday's close. This is the tweet after Thursday's close. The German DAX did get a very, very nice and important bounce in these areas here. We'll see what happens next week. Remember last week we talked about RSI. So far, it appears to be relevant. Dow Jones Industrial Average close on March 18th, Friday. This looks a little bit different than this and this. Dow Jones Composite Average never broke down. Now trying to have a trend reversal relative to this downward sloping trend line from approximately January 1st of this year. If you know your market and economic history, this is really max fear in October of 2008. For the financial crisis, even though the S&P 500 makes a lower low here. So around the 200-week moving average near the major low. In here, Q4 of 2018 near a major low in the S&P 500. Here near a major low in the S&P 500. This is the COVID plunge. In the short run, we'll learn something either way here as well. This chart tells us to keep an open mind about the commodity trade and the energy trade still working going forward relative to adding. We'll see how these things shake out here. Right now, this looks like a bullish breakout and a retest. Economically sensitive travel and tourism weekly. Look at this huge gap up here. Came back, filled the gap, overshot the gap, rallied from here, similar to this, and then closed this week above the 200-week moving average. Covered this one numerous times, low in the S&P 500 software index, trying to make a stand at the 50% retracement. Still incredibly indecisive, but a better look this week. This is a lot like the Dow Jones Composite Index that never really broke down. This is pretty impressive over here for leisure and entertainment, staying above the 200-week moving average thus far. A lot of these looks speak to future economic expectations, which also speaks to the probability of a recession in the present day relative to the probability of a recession here in 2007, 2008, and 2009. Long-term consolidation here, crude oil, natural gas, if we can get back above this line, probabilities improve. Right now, this looks like a bullish breakout and a failed breakout until proven otherwise. This is still a strong uptrend above an upward sloping 200-week. This one would be a little bit more concerning relative to adding to energy and or commodities in the short run. This is energy relative to the S&P 500. Resistance, 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 potential resistance. Thus far, it's acting as resistance. Similar situation here. This is a commodity index relative to the S&P 500. Looks like a bullish breakout. And for now, a failed bullish breakout. Still above the 200-week. A cluster of moving averages, just a different way to look at trends. This tells us to keep an open mind about a big move in physical gold. Price has not cleared this level here. It needs to do so. Some work to do on a relative basis, and this speaks to how much you're willing to allocate. You can make an argument this is a bullish divergence. We know the NASDAQ made a new low this week on Monday. Breadth indicator did not. It was trending sideways. NASDAQ 100 intraday on March 18th. Trends still have barriers, still have work to do. This is reflected in the math, and this is also reflected in our allocations. We've got some improvement and some things that are not good at this point. We'll see what happens in this battleground in here in the coming weeks and months. Even if this is part of a bottoming process, it still may take some time. That's the market's call. Here's the new low in the triple Qs earlier this week. This is the lowest point for the entire decline. And then 1, 2, 3, 4 strong buying power candles to go along with this massive buying power candle here. Like the previous chart, things look better, but some obstacles remain. 50-day, 200-day. The S&P 600 small cap index has not broken down. That is noteworthy. It's a Tony Dwyer concept. You can pause your video player. The 10-week rate of change for the S&P 500 when it moves from below -9, we were down there here, back above -5, which we're trying to do in the present day, that increases the odds that the final low is in. Like everything we cover here, nothing is perfect in isolation, hence the weight of the evidence approach. You can pause your video player. These are subtle shifts that occurred during Thursday's session that told us, despite the red futures overnight, to keep an open mind about a better than expected outcome on Friday. This looks better than anything that we've seen going back to the beginning of the year. This looks better than anything that we've seen in recent weeks. Remember last week we said this move here told us to keep an open mind about better than expected outcomes in the present day. Here's the same chart updated as of Thursday's close, also telling us to keep an open mind about better than expected outcomes during Friday's session and walking forward. Keep in mind, in the 2010 case, there was still some pain ahead. And as of Thursday's close, what were we missing on a lot of these charts? This look over here does not have a thrust look at this point. Of course, this chart will improve after the close on Friday, but the steeper it is, the better, and the faster it moves, the better. We just didn't have that as of Thursday's close. Rates have pushed through all of these areas of potential resistance, now sitting underneath the 61.8% retracement. From about this point here to this point here, the trend in interest rates is up in the intermediate term until proven otherwise. Somewhat of a mixed bag with the VIX as of the close on Friday, March 18th. We closed below the upward sloping trend line from the beginning of January when you use high-low close bars. This tends to lean bullish for the stock market. If we use closing prices, it's a little bit different, telling us to keep an open mind about worse than expected outcomes in the short run. We'll learn something either way here in the coming days and weeks. Just a longer term look at the VIX. Typically, when you get up into this area here, looking out a year, good things tend to happen. This is crude oil versus the S&P 500. Potential resistance right now is acting as resistance. Still needs to clear some hurdles. If it can do so, this would be a massive breakout going all the way back to 2007 here. This is a good look here, turning up. Value line geometric index, noteworthy. We came back to this level here, and this level here, and this general area here, and thus far have held. Can make an argument this is a bullish divergence here as of Thursday's close relative to price. Broad S&P 1500 index broke this downward sloping trend line that goes back to the early stages of the year here. It's possible that we're back testing this trend line here. So like a lot of the other charts, some improvement, some hurdles close by, yet to clear. Gold in isolation, doing some nice things, needs to clear this level out here. That may happen. It hasn't happened yet. This is economic and deflationary fear during the COVID plunge. We don't really have anything like that in the present day, with the concern being inflation. But this still speaks to economic expectations relative to recession odds. Momentum stocks trying to make a stand. Logical area. Some good, some work to do here as well. This is a bullish breakout for defensive assets. Now it's starting to look like a failed bullish breakout for defensive assets, still above an upward sloping 200-day in red. Improving. Look, we get the close here below the Bollinger Band or on top of the Bollinger Band, similar to this look in here. And this week we get a close above the Bollinger Band. Speaks to economic expectations, also speaks to economic expectations. Here's momentum at the COVID plunge. Here's momentum in the present day. Still some work to do, but this and this look better than this and this. We've been showing this chart for a long time. We still have the demographic breakout. And this would tend to say that stocks have a higher probability of outperforming bonds walking forward. It also speaks to increasing inflation expectations, would tend to lean towards increasing and improving probabilities for energy and commodities, possibly gold as well. For now, the breakout's holding. In the short run, value clearly had the upper hand relative to growth. From a longer-term perspective, we've got the W formation stalled at this trend line and still below a downward sloping 200-week. You can pause your video player here. Huge gap up on the weekly chart here. We came all the way back to the gap and for now are trying to make a stand. Discretionary relative to defensive staples trying to make a stand at a logical level, including the 50% retracement. Still has work to do. Still unquestionably in a downtrend in the short run here. However, multiple time frames matter. Look at the same chart on a monthly time frame going back to 2006. Held here, held in this general area here, held here, and still above an upward sloping 50-month moving average in blue for now. You may have noticed this coincides with the market making a stand in 2010 and 2011. This is near the lows in 2016. This is near the COVID low in 2020. For now, this is still in an uptrend. Markets are forward-looking mechanisms, and markets have known for a long time about the risk related to an invasion of Ukraine via Russia. They've known for some time the risk to the energy markets, and they've known for a long, long time now that inflation is running hot and the Fed is going to take action in two forms. They're expected to raise interest rates 6 more times this year and start the balance sheet runoff. None of that is particularly surprising at this point. It's possible that much of the bad news is already priced in. And if the market can rally between now and year end and resume the uptrend, that speaks to positive economic expectations, and it speaks to muted recession probabilities. Conversely, if the downtrend remains, it speaks to increasing recession probabilities. Unquestionably, over the past 4 sessions, we have some improvement in the weight of the evidence that is reflected in our allocation. Some very, very solid-looking breadth data, and we have some other areas of breadth that really haven't checked the boxes yet. Still have plenty of concerns, which speaks to maintaining realistic expectations. Even if really good things happen looking out 12 months to 36 months, as we've mentioned before, it's possible 2022 is a setup year. Market could be consolidating its gains, and there's no question the Fed is now a different animal, an animal that the markets have not seen in some time. Covered this bullet point, and this bullet point via the charts. I have to keep in mind here, it's very, very easy at the early stages of a rally to think that you've missed the move. Very, very easy here in 2016 in the early stages to think you've missed the move. It's almost silly when you think that we just had a signal on Friday that tells us the average gain looking out a year could still be an additional move of 28%. That allows us to prudently manage risk and reward based on the data. Unequivocally, unquestionably, we've seen some significant improvement in the past 4 sessions, and unequivocally and unquestionably, there are still ugly data points to deal with and hurdles to clear. And just as it was important on Monday and Tuesday of this week, we all know The only way any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.